Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at 3 top stocks to consider buying in August for safety and some long-term growth prospects. So amid all of the unknowns, it might be worth considering buying stocks that have really proven they can climb during a rough market and that they operate stable businesses that can withstand these economic downturns we're possibly facing. So the 3 stocks we're going to look at today are Humana, Merck, and Dollar Tree. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So stocks popped in the middle of the week to end what was a slow start to August in the first 2 trading days following what was the S&P 500's strongest showing since November back in July. So Wall Street posted a rather mixed showing on Thursday, and then we saw this market dip on Friday morning, which we're going to get to in a second. But overall, the themes of the market seem like they're going to remain the same in the coming weeks and possibly months as Wall Street continues to assess how higher interest rates, prolonged inflation, and tough to compete against periods and more are impacting companies and consumers. So we saw Walmart warn early last week that it's more price conscious. Consumers were finally changing their spending habits. They're cutting back after an extended stretch of euphoric post-lockdown spending, boosted by stimulus checks, a strong job market, higher wages, all of which are now helping contribute to that bout of 40-year high inflation. And then news broke in the middle of the week that Walmart was actually going to lay off hundreds of corporate workers. Amid all of this, there's now a growing sense, though, that the Fed's aggressive rate hikes and their continued hawkish tone are doing their jobs, with the 10-year Treasury back down from well off its 3.5% peaks in mid-June, which is right when we started to see the market bounce back. That said, though, the jobs report came in super hot Friday morning, so the U.S. economy added 528,000 jobs in July, returning payrolls to their pre-pandemic levels for the first time. Jobless rate also dropped to 3.5% from 3.6%. So this came in well above the median projections that were calling for just about 250K. So we added about 530, and the unemployment rate was expected to remain the same at 3.6, but it actually dropped. So it was a really hot report. They just saw the 10-year yield then pop back up to 2.8% following the news. So this is kind of this divergence we've seen where some industries are starting to lag, but then you still see sectors in the broader kind of hospitality world that are still struggling to find any people to fill these roles. So there's just a very strange economy we're in at the moment. So this creates lots of unknowns, and obviously the Russian invasion and China's COVID lockdowns are making things harder to gauge. And then obviously the labor market shortages we're seeing in some industries, and then job market cuts and some are making it really difficult to project what's happening in the near term. That said, on the positive side, we could see inflation start to come down. So one of the big indicators that's then going to make its way into everywhere in the economy is that oil prices are back under $90 a barrel for the first time since the Russian invasion, with the decline coming amid weakening demand. And obviously the coming weeks are going to be really huge to get some more clarity on the consumer front, especially if we see actual clear guidance from these companies. So we're going to see Walmart, Home Depot, Target, and others all report in the middle of August. So though, with all these unknowns, it might be best to consider buying stocks that have proven, as I mentioned, they are able to climb during these rough markets and can withstand economic downturns and a possible recession. Because even depending on who you ask, maybe we're already in a recession, but then you get kind of in this technical term of what is a recession. No matter what, we're heading into an economic uncertain time. So it might be good to buy some stocks that are able to withstand any of these downturns and the ebbs and flows of the broader economic cycle. So the first of these 3 stocks we're going to look at today is Humana, which trades in the ticker HUM. Humana is a health insurance firm that offers a wide range of plans for Medicare, Medicaid, and individual families and employers. The company operates through 3 core segments: retail, group, and specialty. And its healthcare services segment, Humana's clinical capabilities, resources, and tools include in-home care, behavioral health, pharmacy services, data analytics, wellness solutions, and beyond. So the company has expanded its top line at a rather solid clip for the past 20 years, with only one tiny year-over-year decline mixed in there. The company is poised to benefit from an aging U.S. population, and the company has reported some strong results recently. The company topped our EPS estimates by 13% on July 27th, and it provided upbeat guidance to help it land a Zacks ranked number 2 buy at the moment. The health insurance firm has beaten our Zacks quarterly estimates now for 5 years running. So if we look ahead, our estimates are calling for its adjusted earnings to climb another 20% in 2022 and 12% higher in 2023. And this is going to come on the top of what we're calling for is 12% revenue growth this year and then 9% revenue growth in 2023. So solid top and bottom line growth is expected both this year and next. So given this consistent expansion within a crucial industry in the US, it makes sense that Wall Street's really high in the stock. So at the moment, exactly 12 of the 17 brokerage recommendations that we have are strong buys with nothing below a hold. And its medical HMOs unit is in the top 15% of over 250 Zacks industries. And it pays a dividend. It's not yielding crazy high at the moment. Its yield is about 0.7%. That said, Humana shares have climbed about 15% in the last year to crush its industry's 9% drop. The stock is also up 92% in the past 5 years versus industry's 16% fall, and the S&P 500's 73% climb. And then looking back over the last decade, the stock has rallied 600% versus the market's 200% climb and the larger medical care industry's 93% run. And the stock hit fresh highs in July, and it's currently trading at around $480 per share. And despite that climb, its current Zacks consensus price target represents 10% upside to its current levels. And on the valuation front, Humana is trading at a discount to its own 5-year median at about 18.1 times forward 12-month earnings. And this actually marks a 20% discount to its own highs as well, and 11% value compared to its industry despite that huge outperformance. And it also trades right in line with the S&P 500 at the moment as well, which it's also been able to outperform over the last decade. And the wider healthcare field is really rather recession-proof for obvious reasons, and its stock price performance and growth has kind of proven that out over the last year and over the last 10 years. So speaking of the wider healthcare space, we're going to turn our attention to another company that's in this broader field, and that is Merck, which trades in the ticker MRK. The company is a $220 billion market cap pharmaceutical giant that's climbed about 14% in 2022. The company also topped our Q2 earnings and revenue estimates on July 28th. The firm is also continuing to make acquisitions, and many of its fundamentals make it a rather attractive play for both August and beyond. So overall, it's operates in oncology, vaccine, and other areas of the pharmaceutical industry. So it's diversified portfolio, as I said, oncology, vaccines, infectious diseases, diabetes, and beyond. One of its cancer-fighting drugs, so that one of its oncology stars is Keytruda. So excuse me if I mispronounced that slightly, but it's been the star of the show recently. Its sales climbed 26% in Q2 to account for about 35% of its total quarterly revenues. Overall, the company's revenues climbed 28% in the second quarter. So Keytruda is an immunotherapy prescription medicine used to treat melanoma, non-small cell lung cancer, and other forms of cancer. Meanwhile, its HPV vaccinations, which are Gardasil and Gardasil 9, soared 36% in the quarter, and its COVID-19 antiviral pill has continued to shine as it competes along a similar offering from Pfizer. So both those drugs aim to help treat COVID-19 symptoms and prevent hospitalizations, and they could continue to see broader use in the coming years. Merck's offering has brought in tons of sales so far, with the first quarter revenue for that drug coming in at $3.3 billion, with then Q2 sales at about $1.2 billion, putting it behind only Keytruda and Gardasil in terms of total revenue. The company also bolstered its long-term portfolio last November when it bought Acceleron Pharma for around $11.5 billion. One of that company's prize offerings is an experimental drug that aims to treat progressive and life-threatening blood vessel disorder. And it doesn't appear that Merck's going to stop there. The Wall Street Journal is reporting in July that it's in advanced talks to buy cancer-focused biotech company Seagen. So overall, Merck's revenue climbed 6% in 2020 and 17% in 2021. And our estimates are calling for another 18% growth in 2022 on the top line to about $60 billion. Meanwhile, its adjusted earnings surged 33% last year, with it projected to climb another 21% this year. And then if we peek ahead, both its top and bottom lines are projected to dip slightly year over year in 2023, down about 2%, as it comes up against a really difficult to compete against stretch. That said, on the positive side, it raised its guidance once again last quarter, and its upward earnings revisions help it land a Zacks ranked number 2 buy at the moment. It also has a really strong history of quarterly earnings beats, and it's topped our quarterly estimates by an average of 17% in the trailing 4 quarters. In terms of price performance, the stock's up about 14% year to date to top its large cap pharma market's 1% climb and blow away, obviously, the market's 13% drop. The stock did hit new highs in the middle of July, but it's now trading about 10% below those highs at around $87 per share on Friday morning. The shares have now climbed about 40% in the last 5 years to lag just behind its industry, with Merck up about 95% in the past 10 years versus its industry's 150% climb. That said, the stock is up 15% in the last 12 months to double its industry, and it's trading at about 11.9 times forward earnings, which is good enough for a 30% discount to its own 5-year highs and 15% value to its own median, and it's trading at a 20% discount to its industry. The company's strong and solid performance helps make it 3% dividend yield even more impressive. So its yield currently tops its industry's 2.5% average, the S&P 500's 1.4%, and tops the 10-year U.S. Treasury as well. The company lands a Zacks rank number 2 strong buy. I don't know if I already mentioned that. So alongside that, 10 of the 18 brokerage recommendations that Zacks has are strong buys, with nothing coming in below a hold. And on top of all this, the current Zacks consensus price target marks about 13% upside to its current level. So Merck definitely worth considering as well. And then we're going to end with a company that is way outside of the broader healthcare and pharmaceutical field, and that is Dollar Tree, which trades on the ticker DLTR. Dollar Tree operates roughly 1,500 stores across much of the US and Canada. The discount retailer then late last year kind of made a big change for the first time in its history, change its prices from $1 for everything to $1.25 for everything to help we'll get to that in a second. So they did this though with the new pricing rollout coming in way ahead of schedule. So it's now rolled out everywhere. The higher prices allow Dollar Tree to sell a wider range of merchandise while also maintaining some of the lowest prices in retail, fighting back against inflation and helping improve those margins. So the company also owns Family Dollar, which it purchased back in 2015, which does offer a wider range of price points. And Dollar Tree also has a $3 to $5 quote unquote plus assortment that has performed well as well. So they're not stuck into just that $1 price point. So they're more of a broader super discount retailer. The company operates much smaller format stores compared to Target and Walmart. That's why they have so many of them. And they've really focused on aggressive brick and mortar expansion. And that's helped their revenue climb for decades. And it's poised to thrive for years and years because Americans are always looking to save money, and especially during economic downturns. The company upped its guidance last quarter in the face of what appears to be an economic downturn at the moment, with its positive earnings per share revisions helping it land a Zacks rank number 2 buy at the moment. So in terms of what to expect going forward, Zacks estimates call for its revenue to climb about 7% in 2022 and then another 6% in 2023 to get all the way up to about $30 billion to help lift its adjusted earnings by 41% and 16% respectively. And then in terms of price performance, Dollar Tree has blown away Walmart and Target over the last 15 years, and it's come in just above its rival Dollar General, with the stock up 1,000% over that stretch. This also comes in way above the broader Zacks discount retail industry's about 560% climb. This includes a 65% run in the last 12 months, so it's really been on a nice tear. This is versus the market's about 7% downturn over the last 12 months, and the broader Zacks retail sector's 21% fall. The stock is also up about 16% in 2022, and it's trading about 7% below its April records at around $163 per share. And then in terms of valuation, it's trading at about a 25% discount to its own decade-long median, and it offers 15% value compared to its current industry's level. So it's trading at 18.5 times forward 12-month earnings. And Dollar Tree is really committed to long-term expansion within the segment of retail that's, as I mentioned, never going to go out of style during economic booms or busts. And the $1.25 price point is really going to help boost earnings and revenue and margins over the long haul and in the near term as well. It's also supported by a really strong balance sheet. So it's definitely worth considering as both a near-term play as everyone tries to save money where they can. That said, unlike the other two names on our list, it has not yet reported its second quarter earnings. So those are due out on August 25th. So some people might want to wait a couple more weeks to see how their earnings come in and what their guidance is like. But overall, Dollar Tree is definitely worth considering along with these two other stocks we looked at today, which are Humana and Merck. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.